Welcome, everyone. So, we're on Ask the Experts today. This is the one and only show where we talk about real estate investing, and the viewers get to come on live and ask their questions. So, today, our expert speaker is Kai, and he's a mortgage broker, and he's going to be talking to us. We're going to be focusing on mortgages related to flips and burrs, and just knowing when you'll need which different types of mortgages that are available. So thanks so much for coming on, Kai. Do you want to just tell us a little bit about yourself?
Sure, Dana. Thank you so much for having me. If you allow me, I'm gonna pull up my slides and go through the entire slides. That way you get an idea of what we can do here.
Sounds good.
So first of all, thank you, Diana, and also thank you so much for having me, everyone. So my name is Kai. I'm a mortgage broker and I'm your investment mortgage specialist. So today, let's talk about flip financing. So a little bit of background information about me. I'm a full-time mortgage broker. My focus is on residential as well as commercial investment mortgages. Flipping, bursts, conversions, setting up your rental portfolio. I'm very familiar with these business models, and I can help you structure, obtain, and also exit on these financings. Now, if you and me ever get a chance to work together as a team, if you need, I'm going to supply you with the tools and also other professionals if you need it. So one of the questions that I get most often is, should you always use private money for flips? The answer I'm going to say is no, because if you can finance the entire project by cash, that's going to be the cheapest for you, because you don't have to pay any interest or fees to anybody. However, you do need a large capital to finance the entire project by cash. So alternatively, we can also finance flips by regular mortgages. So these are the mortgages from the institutional lenders. They're going to be cheaper than private mortgages for sure, but you will be start paying interest plus fees. One thing we do have to watch out for is the timeline, because these days I'm seeing a lot of flip deals. They come from the wholesalers. These wholesale deals, they do have an urgent closing, some of them closing within a week. If we're closing in a week, if you're thinking about getting an institutional lender, that might not be able to work out, because institutional lenders, they do need some time to process the entire application and also the funding as well. To be on the safe side, we need 2 to 3 weeks to get the entire process done. So make sure you negotiate your closing date if you can. If that's not negotiable, then good chance we will have to use a private mortgage in order to close as early as possible. Now, when you go for an institutional mortgage, make sure you are picking the right term. The reason I say that is fixed rate mortgages, they can be very expensive to break. And if you're paying a very hefty penalty, that's going to eat into your profits. So instead of focusing on the rate, let's focus on the term. So open term or variable term, they're pretty good, and they can help you minimize the penalties. Make sure you keep more profits in your pockets. Another common way we can finance a flip is by private mortgages. This is probably what most people use. Private mortgages, they're fairly easy to get. It's very minimum income or credit verification needed. The funding can be very fast, 24 hours, 48 hours. There's no problem with this. However, it's more expensive because the payments are interest only, and you will incur more fees than the traditional mortgages. For example, broker fee payable to the mortgage broker, lender fee payable to the lender. And if you're borrowing more than $50,000, you need 2 lawyers, one to represent you and another one to represent the lender. But the good thing about private mortgages is you can negotiate the terms. So if you are doing a short-term flip, let's say 3 months, so there's really no point for you to pay a penalty for 2 months. So you can negotiate and make the term into an open term, meaning you can pay them out anytime you like. There's going to be no penalty. On top of that, you can also negotiate your renew policy. So that means if the project doesn't go as planned and you need another 2 or 3 months, and so that you have to renew. So we need to talk about the renew policy up front to make sure there's no surprise payments down the road.
Yeah, all great.
Another question I get, sorry?
Oh no, I was saying all great points, and it was really good that you mentioned even just something like that. Like something that's super important is that if you are going short term, but your house is in really good condition and you're closing short term, you may still have to do that private lend just to help close you out to give you time to find that actual other mortgage.
Exactly. Time frame is it's one of the key determinants here.
Mm-hmm.
Yeah. So move on to the second question. Another question I get quite often is, what do you need to prepare in order to get a mortgage? So for this question, guys, it really depends on what type of mortgage we're going to use. So if we're going to use a regular institutional mortgage, we need to stay on top of your I's. That is your income, your credit, and also your equity. So equity, in simple words, is really your down payment. We need to have your down payment ready. For rental property, most of the lenders will start you with 20% down payment. If we're going for a private mortgage, we also need to have the down payment ready. Once again, the private mortgages, most of the lenders will ask for 20 or 25, depends on where the property is, but usually they're gonna start you with 20% down payment. Another thing is, if we're getting a private mortgage, I strongly recommend everybody to prepare an exit strategy. In simple words, that means how are we gonna pay out the private lender? Because they're expensive and also they're interest only. Most people will pay out the institutional lenders by doing a refinance with the institutional lender, use the institutional money to pay out the private lender. And if you are doing a flip only and your intention is to sell it, then we can use the proceeds to pay out the private lender. So these ones we do need to know upfront, because the private mortgages, once again, they're expensive to carry. Generally speaking, in order to get a mortgage, any type of mortgage really, institutional, private, you do have to have your personal taxes up to date. The reason here is CRA is a very powerful creditor. They can knock on doors. If you stop there with them, they can knock on doors, seize all type of assets, and even go after your account receivables. Now that's where things get really ugly. But make sure if you are thinking about getting a mortgage, make sure you are up to date with your taxes. Another thing for investors to watch out for is we really need everybody to complete their due diligence up front. By saying due diligence, what I mean is we really need to estimate your profits from this project, and also check your bank accounts to see how much capital you have is available, and also try to do a walkthrough on the property, making sure the property doesn't have any surprises for you. So to make your job a little bit easier, I do have a calculator that I can share with you. This is going to help you with your due diligence on the profits estimation. So this calculator breaks down all the expenses all the way from acquisition, selling cost, and also the carrying cost. Here it's called the operational cost. And also it's going to give you an idea how much you're going to spend on the financing costs. And once you put in your renovation budget and also a timeline, the calculator is going to auto-populate and give you an idea how much profits you're going to make from this specific project. So reach out to me if you need a calculator like this. I'd be very happy to share this with you.
Yeah, that looks like a great resource. Do you want to just quickly run through each one of them? I'm just curious to see, just
sure,
so people can understand it.
Yeah, so as a matter of fact, that we can talk about this later on in the slides. I do have another case study. We can talk about this later on if you don't mind.
Okay, perfect. Sounds good.
Yeah. Another common question I get asked is, can I get 100% financed? The answer is yes and no. Here I have a case study for you. This is a very recent one I did last year. It was right before Christmas. My investor was purchasing a property for a flip in Hamilton. The purchase price was $172,000. Surprisingly, we hired an appraisal company, and the value was over $300,000. So the lender felt very comfortable to give the investor $172,000 because the actual loan to value, the loan requested, that's $172,000, to the value of the property $300,000. the loan to value was actually just 57%. So the lender felt very comfortable, and my investors will finance the 172, no problem. They got 9% interest rate and also 2% lender fee, which is very common for private mortgages. And also considering this is 100% financed, so I do think they got a very good deal. So what that really means for you is if you want to get 100% financed as an investor, we really need you to find a property that's underpriced. So if you find a property similar to this one I did the last December, we have a chance to get you 100% financed.
And is there any chance to, let's say, with this kind of situation, to get a conventional mortgage at 100% loan to value, or it would only be private financing?
That's going to be a very good question. So it depends on, there are several moving parts here. So it depends on the closing date and also the strength of the applicant. I cannot guarantee it's going to be 100% financed with the institutional lender. Even if they are, it's going to be 100% financed for the purchase price as well, but not going to be the appraised value of the property.
Sorry, so you're saying that yeah, so they could, so a conventional mortgage could actually, depending obviously on like what they see in you could actually get it 100%, yeah, to the purchase price. So there is that possibility. So you may not have to go private.
You may not have to, but usually the institutional lenders, they're going to ask for a down payment. Because the institutional lenders, they usually have a very strict guidelines. They do ask for a down payment to make sure you're putting your skin in the game. So institutional lender 100% finance, so far I have not done such a deal, but there might be chances if you can find a deal like this.
Okay, interesting. What about so something that I've also heard about, and I'm curious to hear your opinion, is like that what we just spoke about, where you're closing, let's say in a week, it's a quick closing, and you get, let's say you get a really good deal, but again, you got to go private because it's a quick closing, but then you go to finance it with a regular bank. Does that mean, let's say if you again got something like this where you got it really undervalued, what are the possibilities like for even, let's say, with refinancing after closing within like a month or two, and let's say getting, like, doing a refinance? Because usually when you refinance, they're doing, let's say, 75 to 80% loan to value of the appraisal. Would that count? Or because it's so soon to the purchase, do they take the purchase price? Or does it again vary, depends on the institution?
That's a very good question. So that is the exit strategy I designed for this investor. Because once you're done your work, once you're done your renovation, the property value is going to increase again. And by then, you can definitely pay out a private lender and go to institutional lender if you can qualify. So to answer your question, there's no hard no on yes or no on this type of request. So this can we can definitely go to the institutional lenders after 2 or 3 months.
Okay, that's good to know.
Yeah. So another specialty program here I have for flippers is the $20,000 down program. And yes, it's $20,000 down, it's not 20%. And this is how you can qualify. So one of their major guidelines is to make sure it's going to be a profitable deal after all. And this is how you can, this is what we need to do to make sure it's going to be profitable. So we need to verify the ARV, the after renovation value. So we need to put some comps with the realtor, check the sold ones and also the active ones to see how much the properties are getting sold for in this specific area. And that gives an idea how much we can sell this property for once the project is completed. We also need to check your renovation budget, how much you intend to spend on this project, and also your timeline, because different timeline means different carrying cost. We also have to check your bank account to see how much capital you have is available. The idea here is we need to make sure that you have sufficient money to cover the expenses during the renovation, and also the money for the renovation itself. Property condition, that's another important factor to consider. You do want to buy a property that's in reasonable condition at least. Another thing to watch out for is it's going to be tenanted or it's going to be vacant upon possession. Now, if the property is going to be tenanted upon possession, that might be a problem because you won't be able to do a flip. Ideally, we do want to get a property that's going to be entirely vacant upon possession.
Have you seen those kind
so
of
here I
houses?
have another case study. I do. I just have to give up another one in Stratford because the tenants, they don't want to leave. And my flipper clients, they don't want to offer cash for keys. So they have to let the deal go. Otherwise, it was a very solid deal. Yeah. So for this one, this is a very recent transaction I did. It was actually funded on the 2 days ago on the 18th. So and this is where we can see the actual numbers. So this deal was in St. Catharine. So the purchase price was 520. That's how much the purchase price was. So my investors, they put in 20,000 for the down payment, and they were financed for the rest. And this is why the deal was so good, because we had to look at the ARVs for this specific area, and the house itself, similar conditions, they're getting sold for 680. The renovation plan is only going to last for 3 months, 2 months to do the work, and also 1 month to sell it. So in total, it's just a 3 month. And renovation budget was 35,000. So we put in the acquisition cost. I used 1.5% for the land transfer tax, and also 5% for the realtor fee once the project is completed. Carrying costs are pretty standard. After weighting all the expenses, and after all, they got a property at 520, and if they're gonna sell it for 680, in 3 month work, they're gonna get a net profit of 47,000. And this deal was very profitable. Their cash on cash return was over 54%. So this deal was definitely a winner. They got financed. The lender's happy. The investors were very happy as well.
So a question actually about the 20K down. So what makes this, so this again, the 20K down, that's probably private money, right? These kind of things don't exist in conventional mortgages?
This is private money. Conventional, if you are buying a rental property, you do need a 20%, not 20,000, 20%.
Mm-hmm. And
so this $20,000 down, oh, sorry.
No, go on, finish.
So this $20,000 down program is really good for people with limited capital. Because if you do 20%, that's gonna be about 110,000 you have to invest into the property in the down payment. And you also have to come up with the renovation money as well. So in total, we are looking at 140,000 at least. So my investors, for these two particular investors, they didn't have that much. What they had is they have more than this, which is 20,000 for the down payment and also the carrying cost, the renovation budget. So to get this program, all they need to, all the capital they have need access to is just 87,000. My investors had more than this, so they can qualify for this program. But the 20% program, traditional lenders, they won't be able to qualify.
And let's say for those kind of private lenders that do the 20K down, because that is, you know, a small amount that they're asking for, what makes them feel secure to actually private lend that money? Like, do they have any specific criteria that they look with the kind of houses they're willing to lend for?
There's no requirement on the types of properties. their guideline is really making sure it's going to be a profitable deal. So once again, the purchase price has to make sense. The ARV has to make sense as well, making sure there's enough gross profits. That's why I was going through the details here. They look at the entire project and putting your renovation budget, calculating your carrying cost, your acquisition cost, selling cost, financing cost, to make sure you have a profit. So once again, back to their guidelines, it's if you have a profit in this deal, they're gonna be comfortable lending you the money.
Okay, so makes sense. So basically, and as you were saying, doing the due diligence. So as long as you as an investor have all your numbers set and you can prove to them that you know what you're doing, and that like the numbers are making sense, and you have your contingencies, they're happy with that.
Mm-hmm. That's right.
Awesome.
That's right. So just in case you need more information from me, I'm available on Instagram. I try to be as active as I can be. So if you have any question, feel free to reach out to me. If you gave me a question that I have not answered on my Instagram, I'll answer that with a TikTok video and also a post as well. Alternatively, you can reach me on Facebook by typing my name. I'm also available on LinkedIn. Here's my cell phone number as well, my email. You can connect with me whichever way you like.
That's awesome. Thank you
And
so
that's
much.
pretty much it.
Yeah, thank you so much for
My
all the
pleasure, Dana.
information. Do you
pleasure.
want to go back to your question about, I think it was your first question. I wanted to actually ask something about it.
Sure.
I just,
The private money one, this one?
yeah, private money. Yeah. Yeah. So can we go and talk more about, I guess, the differences between a regular mortgage and a private mortgage, just going into more details about it?
Sure. So first off, private mortgages are provided by institutionals and also wealthy individuals. Regular mortgages, they are provided by institutional lenders only. Another major difference here is their interest rate and also the fees. There's a massive difference between these two. Private mortgages, first mortgages, they can go anywhere from 7+2 all the way to 9+2 or even more. These days, institutional mortgages, they are usually, it depends on the use of it. Owner-occupied, rental, they're different. But rental properties, you can get 2 to 4% on the interest rates.
So for example, actually, do you see, let's say, like rental properties using private money, or do you see it normally being just for flips, or like short term, as in just doing renovations and then refinancing, or doing renovations and then selling the property?
There are people who are having private mortgages on their rental properties because sometimes their income is it's not the best as of right now, or their credit is in the best shape. So that's the only type of mortgage they can qualify for. But private mortgages, they are meant for short-term use only, ideally for flips. If they can improve their income and also their credit score, definitely we want to take them back to the institutional lenders, helping them save money on the interest rates and also improve their cash flow.
Mm-hmm. And so do you, because like, let's say, for example, where people are doing, let's say, real estate investing full time, they're some, like, for example, like their rental property income doesn't count as the same as your job income, right? So how does like how are they able to, like, would they also then afterwards just always have to be private?
So to clarify a question, so you mean somebody is a professional real estate investor and all their income comes from rental income? Is that a question?
Because I know there's differences, right? The rental income that you get is considered differently to income from a job, let's say, right?
Yeah, they're different. Rental income, it is a recognized source of income. That's not a problem. It's just different lender have different policies on how much rental income we can use. The term here we use is called offset or add-on. That means we really depends on the situation, but some of the lenders, they won't allow you to use 100% of your rental income as your income. But employment income, it's usually 100%. We can use 100% to help you qualify for the mortgage.
And so between so have you ever dealt, let's say, with just someone who's just an investor and has rental income? Or like how do you because then you must have to treat them a little bit differently than, let's say, with someone who has a job, right? Like what are the
Yeah,
differences that
that's
you
a very
see
good question.
between the two?
Um, so there's no major difference. Income is income. It doesn't matter which source it come from. If somebody's a professional real estate investor full time and all their income is rental income, this type of financing can be done, but this type of financing has to be done with the right type of lenders. And this type of lenders, they're usually outside the mortgage broker channel, but you can qualify for an institutional mortgage using just rental income. That's not a problem.
Oh, okay. That's good to know. It's just like
Yeah.
you said. So what do you see the percentages usually on average are that they allow to be considered income? Like what percentage of the rent do you normally see?
Once again, it really depends on the type of lender and their guidelines. We can do all the way from some of the lenders, they only use 50%. Some of the lenders on the subject property, they can go up to 100%. And also it depends on your portfolio and the debt service ratio of all your rental properties minus from the debt service ratio from your entire portfolio.
Okay.
But you can, so what, yeah, but to answer your question, it really varies from lender to lender.
Yeah. No, that definitely, I know
Yeah.
everyone's different, but it was just more to see like what is average or what do you normally see, which you answered. So that was good. Um, so then for regular mortgages, can we talk about, for example, let's say not considering the term, the length, like let's say you do have enough time to qualify for the mortgage. Let's say the closing's like a month and a half away. So you have more than enough time to do your due diligence. What are some
Mhm.
factors that you see that could still impact the mortgage from like for them not getting the mortgage and not including, let's say, their income, also like not considering their income, like specifically related to the property itself? Like what are things that people need to
Mhm.
take into consideration that may say that, you can't use a conventional mortgage and you may have to go private?
That's a very good question. So for this one, we have to look at the eyes. It's really your income and also your credit and also where the down payment is from. So let's say they have sufficient income, but their credit score is really bruised. Now that might jeopardize their mortgage application. Some lenders might decline solely based on credit. They don't like to, if they have not been, responsible on managing their finances, even if they have great income, the lender can still say, I don't feel comfortable lending you the money. Sorry, I'm not the best person for you. They're going to decline. Now, also the equity, the down payment, the lenders also look at that. So some of the equity, the down payment, some people, try to be really creative, borrow money from there and here. If the lender have question regarding where the down payment comes from and really question the legitimacy, they also have another reason to say, no, we're not going to finance this deal. So if somebody has good income but has bruised the credit score or their down payment isn't that clean, that might also cause problems. But regular mortgages, all we really need to care about on the personal side is the eyes, income, credit, and also equity. Now the property itself is another story.
So and
Does
so
that
what
answer your
about
question?
well, actually my question was more on the property side, like what for the property itself can prevent or benefit you to getting a conventional mortgage or not getting it and having to go private?
So most properties are going to be okay to be financed by institutional lenders. Now, some of the properties, they're in rough shape. The institutionals they're not going to like this type of properties because they're if the property, let's say the property has structural problems or it's really in rough shape and needs a lot of renovation, a major renovation, let's say, institutional lenders, they're not going to like this type of applications. If it's going to be in rough shape, you might as well want to stay away from it because it might collapse tomorrow. Nobody knows. Now, if an application goes to the lender, it's for a really for a property that needs a major renovation. Some of the institutional lenders, they might lend you the money, but they're going to look at it as a construction mortgage. So what that really means is you probably have to you're going to get the money by the progressive draws. So you're not getting the money upfront in one lump sum payment. They're going to give you several different payments, and they might have to order appraisal, inspection on different stages to give you the money. So the property, the condition, and also the assessed value, they look at these things to determine how financeable this property is going to be.
Okay, that's good to know. So then there is then a
possibility. Question.
Yeah, so there is then the possibility, even if it's in bad condition, it just may be a different kind of mortgage or like you said, construction loan that you may have to look into. So then would you say then in general, then you would so really private loans then are really only for like if it's short term then, or just or and I guess income based, yeah, because if your income's not enough, you may go private. So really those are the only cases, because it sounds like you can then use you can go into an institution even if the flips are like a huge major flip.
So your question, sorry, can you say your question again? Sorry.
So the question is that that it sounds like it almost doesn't matter the condition of the property that much, because there are institutions that will, for example, finance, let's say a flip that is, let's say, a full gut. Is that what you're saying?
There are, but they're going to look at this as a construction loan. So it's going to be hard. It's going to be harder to qualify, and you also need a bigger down payment.
Oh, okay. Whereas a private may still do the regular 20%, because they're more of just as long as they're getting their 20% down, they're happy. Okay, that's good to know.
That's also a very good question. So some of the private lenders, if they know that this is going to be a gut job, they also might want to do it as a construction mortgage. So they're gonna do inspections, appraisal on different stages, and also give you the money by several different payments too.
Okay, so you could even see it on the private
lender.
Too.
Yeah, I have a private lender. He does renovation loans, and he goes out to inspect the property himself.
Oh, okay.
Yeah.
So he must know a lot about renovations then, because he's, I guess, to look at it himself, he's actually probably seeing how much it would cost, I guess, right?
Yeah, he has been doing this. He has been involved in real estate for more than 30 years. And if he has to take over the project, he has the manpower and also has the knowledge to complete the project.
Oh, okay. That's very interesting. Yeah, there's lots of different types of even private lenders too.
There are, yeah, definitely. Construction, renovation, regular private lenders. There are so many different types.
Mm-hmm. That's awesome. I wonder, anyone have any questions? I think we've answered all of them.
Any questions?
Actually, could we quickly go through the calculator one more? Did we actually go through it? You kind of quickly talked about it, but I wanted to actually just go through each section a little bit more. You can go through what the example.
No problem. Let me pull up the actual calculator so we can take a look together. We can also even run some numbers if you like.
Sure.
Just give me a second. I have to open up the calculator. So here we are. I'm going to share my screen again. Are you guys seeing my screen okay?
It's just loading. Okay, perfect. Yeah, I can see it.
Yeah.
Okay, so for the purchase,
Okay.
let's start with, or do you're so
Mhm.
is your financing connect, I guess, all the other ones together? Is that how you have it, or because you wanted to go directly to financing costs? I was just curious. Or that's just, oh, I guess that's where you start because you put the purchase price and everything in there.
Usually I start with the purchase price and also the ARV. If it's not going to be a profitable deal, then I don't have to go through the carrying cost. There's no profits. There's no point.
That's true. That makes sense. So if we were to use this, then we start with F. So your section F, financing costs, and let's say, do you have standard numbers? Like well, I guess, yeah, you would have the standard numbers.
Yeah,
like let's say if it's a person that's going to do this themselves, like if they have 20% down, let's say, how much would you suggest that they do the interest rate at?
If they have a 20% down, depends on where the property is going to be. I can do any from 7% to 9%.
So probably better, like for estimate
Yeah.
purposes, doing 9%, let's say, just starting high and then hoping for the best that you get less, right?
Yeah, we can do that. So let's just come up with, let's say we found a property today and
Okay.
it's selling for 500,000 and we have a 20%, which is 100,000, no problem. And we take a look at the surrounding areas. Looks like properties of similar condition and shape are selling for, let's say 680 still. Now, if you have 20% and let's say the lender's going to give you 9%. So each month, your interest payment is going to be about 3,100, and every day that's about $100.
Okay.
And we're taking a mortgage of $400,000. And other things will probably be the same. Legal costs is going to be the same. Inspection fee is going to be the same. Appraisal, if applicable, it's going to be the same. The only thing that's going to be different is the land transfer tax. Depends on which city you're buying your property. But let's say you're not buying in Toronto because Toronto is double tax, right?
Yeah.
So let's say anywhere, let's say we're going to use 1.5% of the purchase price for estimation purpose. So 1.5% of 500,000, it's going to be 7,500. So let's put in 7,500. And also because of the ARV, ARV is 680, 5%. Let me just quickly calculate.
Okay, so this is once you've done the renovations and you're ready to sell. So this is what section C is for.
Yeah.
Right?
So this is the selling cost.
So yeah, you have the agent, which you're doing it at, you said 5%?
5%. Most of the agents would charge 5%. Some can do better, but to be on the safe side, let's just use 5%.
Exactly. And then, right. And then you have the discount there, the legal fees, title insurance, second appraisal, land transfer tax. Okay.
Yeah.
And then for the
carrying cost, we can, for the purchase, sorry?
Oh, so yeah, I was just gonna say for the purchase price, so you do the legal costs. So I guess you would consider both, in the legal costs, like if you're going private, you'd also consider the private expenses in there too, because you'd be considering the legal costs would be for you buying the property. Also, if you're going private, then you'd have those extra expenses too, right?
Yeah, on the legal fee, if you're going private, you need 2 lawyers. So let's put in 2,000 for 2 lawyers.
That's right, yeah.
Right?
Mm-hmm.
Yeah, so this is your acquisition cost really, and this is your selling cost. The carrying cost is here. Let's say electricity, gas, utility, let's just put 100 here. Water is going to be cheap. Alarm system, if you don't use, there's no fee. Snow removal, lawn care, if you're doing this yourself, obviously there's no fee. Insurance, property tax, if it depends on what type of property you're flipping. Condo fees, if applicable, just including here. Otherwise, just put 0. And this is determined based on the length of the property, the length of the project. So 3 months, your utility payments is going to be this much. That's why the timeline is also very important, because different timelines going to determine different carrying costs. But let's stick with this 2-month renovation and 1 month to sell timeline.
Mm-hmm.
In total, it's 3 months, and renovation budget we can still use 35.
Yeah.
Now, this project, based on the numbers, it's going to be very profitable. After all the carrying costs and also all the expenses for selling, acquisition, you're still making about 80,000 in profits.
Mm-hmm.
And what's nice about this calculator is it breaks down the different type of expenses and how much their weights.
Oh, that's nice. Yeah. Oh, so that's G. Okay.
Yeah.
So you have your total cost, total purchase cost. Sorry. But but it says 10,000. It's not 10,000, is it?
It is 10,000. So you got two sets of legal fees, title insurance, also land transfer tax, and property adjustment, tax adjustments.
Mm-hmm, mm-hmm. Oh, okay. Those costs. Those are the purchase costs. Okay. Oh yeah. Sorry, that even said it there. Purchase costs, operating costs, finance costs. Okay, renovation costs. And then your summary total cash needed. Oh, okay, that's nice. Okay, this is the part that I was thinking about. That's nice to have. Total cash needed, return on cash investment. Yeah, return on annualized. Okay. And ratio of cost.
Mm-hmm.
Can you go through those calculations? I'm pretty sure some people would be interested in knowing how you calculate those.
So it's quite simple, as a matter of fact. So you look at the ARV to determine the gross profits minus the purchase price. So that way you can determine your gross profits. And the expenses are determined here: the carrying cost, the selling cost, and also the acquisition cost. You use the gross profits minus expenses. That's your net profits.
Mm-hmm. And then so total cash is just you've done what, down payment, and then again all the other costs, right? The total purchase cost, selling costs, operating costs, and renovations, plus down payment, right?
Yeah. Plus down payment, renovation, carrying cost.
Mm-hmm. And then so return on cash investment.
Yeah, return on cash.
So how do you
return on cash is so that's your profit. So return on cash. So this is how much cash you invested, and that's how much your return is. So it's basically use this number divided by this number.
Mm-hmm.
Yeah, how much you're getting against how much you invested.
And so how do you do the annualized one? How is that calculated?
The annualized ones, it doesn't really apply. As a matter of fact, it's a 3 month, right? So it's basically one season. So you just use this one season. So basically there are 4 seasons in a year. So you just use this one times 4. But annualized interest rate, annualized returns don't really apply, because we're not going to carry this project for a whole year and to find another identical one for another flip. So this one doesn't really apply.
So then, yeah. So when would you apply this then? Like you still apply. So you're saying you would, or because you're saying like, let's say if you're doing a flip, if your flip is a year long, let's say, well, how would you show the difference between the return on cash and then the return on, the return on cash and the one annualized? Like how are those two different?
So let's say let's say the project is gonna last 12 months. So it is 1 year, so there's no need to annualize it. So the return on cash, you're gonna have this much profits. This is how much you invested, and this is gonna be your return, your COC return, your cash on cash return, right? Because now this one, the entire project is gonna last for 12 months, so that has been annualized already. So these two, they're gonna be exactly the same. You don't need to analyze anything.
Okay, so your annualization is if you're thinking that, let's say you could pump out, for example, because the first one you're doing is 3 months. So you could probably pump out like these exact projects, like 3 of them, 4 of them in the year, let's say. So you'll be calculating it annualized is like if you do this kind of project 4 times in a row, this is actually the amount of money you're making, right?
That's the idea. So if you can find identical or very similar projects and do them all in a row, then probably that's what are you gonna get for this year, right? So if you have a project for 3 months and another very similar one right after, and another one right after for this entire year, you're gonna have a very solid return of over 200%.
Mm-hmm. Okay.
Yeah.
And then so ratio of costs to ARV. So what is that calculation?
So that means how much you invest into the rental. So basically, it's how much rental you invested in order to get the ARV.
Okay, so it's renovation only. Renovation divided by
renovation and also the carrying cost.
Oh, the carrying cost.
Renovation cost. That means, that means to get this kind of ARV, how much do you have to spend on it?
Okay, so in that one, then not including the purchase costs or the selling costs, just in the time period that you're actually holding the house.
That's correct.
Okay, so it'd be that amount divided by the ARV. Is that what you're doing?
That's how it's calculated.
Okay. And then variable monthly cost. Is that the mortgage variable monthly cost? Is that what that is? Or what's variable monthly cost?
The mortgage is gonna be a fixed payment. It's just your carrying costs, it might vary. Depends on how much utility you use, what kind of insurance you're getting. But this gives an idea how much your overall cost is gonna be every month.
Oh, okay, including your holding cost and the mortgage.
Yeah.
Yeah. Oh, okay.
So this gives you an idea. Yeah.
And then
and also this is a this point's very handy. It tells you if you do have to extend your project for another month, how much profits can you expect, how much expenses to expect, and if you can do it faster than your schedule, how much can you make?
That's awesome. This is all really great information that that anyone could use, and it, like you said, it even gives you a bit of a forecast, which is also kind of nice to have.
Definitely.
Yeah, so thank you
so this
much.
Calculator is available.
Yeah,
sorry, this calculator is going to be available. If you would like to have it, just send me an email. I'll attach this and send it to you.
Yeah, or what you could also do in the group, you could also, there's an area you could add documents, and you could even put it in there in the group, so people can grab it whenever they need from the group too, if you want.
Sure, I'll do that.
Yeah, because I think a lot of people find a lot of value in that. That's a really good calculator that you've created there.
Yeah.
Yeah, thank you so much for coming on. It was really awesome having you on, and you provided a lot of value, and I think everyone will really enjoy this video.
I would really appreciate that, and thank you so much for having me on.
Yeah.
So are there any questions, any comments?
Let's give maybe a second or two to see. So thank you for
You're
sharing
welcome, Justin.
the valuable calculator. Yeah, that looks like I'm pretty sure a lot of people are going to love that calculator.
That's gonna make your due diligence so much fun.
Mm-hmm.
and so much
Easier
easier
and
too.
fun, yeah. Makes it fun because it's easier and you don't have to stress about it. Don't get
Yeah,
stuck in
exactly.
analysis paralysis. You have his calculator now.
Exactly.
Awesome. Thanks so much. It was awesome to have you on, and we'll see everyone on to the next show. Bye, everyone.
Definitely.
Bye,
Thank you so
Kai.
much,
Thank you
everyone.
so much. Bye.
Take care. Bye now.